Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
Glad to be here for this one.
Yeah, today we are looking at a truly fascinating disconnect in the current economy. Based on recent analysis, there is just this massive gap between what politicians are saying to the cameras
Right.
and what the financial markets are actually quietly signaling behind the scenes.
It is a critical topic.
Mm-hmm.
And it centers around a number that affects absolutely every single American household, regardless of where you live or what you do.
You mean the price of a barrel of oil?
Exactly. The price of oil.
Right. And this disconnect, it really starts at the very top. President Trump recently made major headlines regarding the surging oil prices we're seeing amid the ongoing military conflict involving Iran.
Yeah, that Reuters interview.
Right. On March 5th, he was asked directly about the rising cost of gasoline for the American consumer. And his response was essentially, if it goes up, it goes up.
Which is quite the statement.
It really is. He made it very clear that prioritizing military operations and broad national security objectives right now takes absolute precedence over the price at the pump.
Which, when you look at it through a historical lens, is a remarkably relaxed stance. Because historically...
It's political kryptonite.
Exactly. The price of gas is political kryptonite.
That's exactly why this caught my attention. American presidents, including Trump himself during previous terms, are usually hypersensitive to gas prices.
Oh, absolutely.
I mean, it is the one economic indicator that Americans see literally every single day. It's printed in giant neon numbers on street corners across the entire country.
You don't have to log into a brokerage account to know if gas is up.
Exactly. So, the mission of our deep dive today is to figure out if this relaxed attitude is justified. We're going to translate a lot of Wall Street speak into everyday terms for you.
Right.
We really want to answer the big question. Are we heading for a massive structural economic crisis that's going to wreck our retirement accounts? Or
was this just a temporary bump in the road? To answer that, we really have to look past the political rhetoric. We have to dig into the actual market mechanics.
Okay, where do we start?
We can actually think of the current situation using a swan analogy.
Oh, I like this. Like a swan gliding across a lake.
You got it? Above the surface, the swan looks incredibly calm, graceful, completely unbothered.
That's the public face of the administration right now, the if it goes up, it goes up vibe.
Precisely. But if you look underneath the water, the swan's little feet are paddling furiously just to keep moving forward.
Ah.
According to the research data behind closed doors, it is a completely different story. The White House and the Treasury Department are actively and quite aggressively exploring options to lower these price pressures.
Yeah, hold on. Exploring options? Like what? Because saying if it goes up, implies they're just going to let the free market do its thing.
Well, the internal data shows they're actually considering intervening directly in the crude futures market.
Intervening in the futures market? That doesn't sound relaxed at all.
No, it doesn't.
That sounds like a fire drill. How does the Treasury even step into a global commodities market of that scale?
It's highly complex, but essentially, it means they are very sensitive to these market signals and are desperately looking for levers to pull.
Okay.
They might look at strategic releases of crude reserves, or they might try to apply regulatory pressure to calm the trading frenzy. The point is, the swan is paddling furiously.
So the calm is calculated.
Right. The administration's outward confidence isn't based on simply ignoring the economy. Instead, it relies heavily on a very specific and honestly somewhat optimistic assumption that the financial markets are currently making about this whole geopolitical conflict.
Okay, so the president's confidence is basically leaning on Wall Street's current forecast.
Yes.
To understand why the White House feels they have breathing room, we really have to look at the futures market. And this brings us to a terrifying-sounding Wall Street term that came up repeatedly in the analysis.
I know exactly the word you're going to say.
I have to ask you to explain this one because it sounds like something out of a sci-fi movie. What on earth is backwardation?
Backwardation. Yeah, it is a terrible, clunky word for a concept that is actually very intuitive.
Please break it down for me.
Let's step completely away from Wall Street for a second and use an everyday analogy. Imagine your absolute favorite band announces they are playing a surprise one-night-only concert in your city tonight.
Okay, I'm with you. The hype is through the roof.
Exactly. Because the concert is tonight and everyone is in an absolute panic to get in right now, scalpers are going to charge an absolute fortune for those tickets.
Sure.
The price for immediate delivery of that experience skyrockets.
Yeah.
People will pay anything because of the immediate scarcity.
Makes sense.
But let's say the band also announces a massive regular stadium tour for 6 months from now.
Oh, I see where this is going.
The tickets for that show 6 months out are just normal face value price.
Gotcha. The panic premium is strictly about getting access tonight. If you can just wait 6 months, the panic completely disappears.
Precisely. That is backwardation.
Okay, so how does that apply to barrels of oil?
In commodity markets, backwardation is when the price of taking delivery of something today is drastically higher than the price of securing that exact same thing a few months in the future.
Right.
Now let's map that back to the oil market. According to the data from March 6th, that is exactly what is happening with Brent crude.
The global benchmark.
Yes. The near-term market, meaning the oil being physically delivered right now, is trading at about a $10 premium compared to the futures contracts for oil delivered 6 months from now.
$10. In the context of oil barrels, a $10 gap between today and 6 months from now seems massive.
It is a huge gap. And if you look even further out, the long-term Brent prices are actually sitting very comfortably under $70 a barrel.
Wow. So the market is entirely focused on the immediate panic.
Exactly.
Yeah.
Furthermore, the data shows that oil producers are looking at this sudden, massive spike in the tonight price, and they're scrambling to hedge their production.
Wait, what does that hedging actually look like in practice for, say, an everyday business?
Imagine you run an oil drilling company down in Texas. You see the price spiked to $90 today because of overseas panic.
Okay.
You don't necessarily believe that $90 is the new normal. So you rush to Wall Street and sign contracts locking in the right to sell your future barrels at these elevated prices.
Essentially protecting yourself before the price inevitably drops back down to reality.
Right. They are cashing in on the panic while they still can.
Okay, so if I'm an everyday American listening to this deep dive, why should I care about the term structure of Brent crude? What is the practical takeaway from all this backwardation talk?
The practical takeaway is the market's psychological state. The market is screaming a very clear message. This is a short-term panic.
Not a permanent crisis.
Right. The current price spike isn't because the world is running out of oil. It's being driven by immediate logistical nightmares.
Like what we're seeing in the news.
It's exactly. Massive shipping delays, skyrocketing war insurance premiums for cargo vessels, and huge traffic jams of oil tankers trying to navigate safely through the Strait of Hormuz.
So it's a logistical nightmare, not a permanent end to the world's oil supply.
Precisely. The financial market is pricing this as a time will heal shock. The oil is still physically in the ground, the wells are still pumping, the refineries are still operating.
It's just incredibly difficult and expensive to move it across the ocean right now.
Right. And this is exactly why the White House feels they have a window of opportunity. They believe they have the time to resolve the military issue and achieve their national security goals before this temporary logistical headache morphs into a permanent economic disaster.
Because they are betting that the future price, that sub-$70 number, is the true reality.
Exactly.
Okay, the logic holds up. But I have to push back a little here.
Sure.
Whenever we talk about oil shocks, there is one year that immediately pops into every American's head and strikes absolute fear into their hearts. 2008.
Oh, yeah. 2008.
I remember paying well over $4 a gallon back then, and it felt like the entire economy was collapsing under the weight of it. People are terrified right now.
Understandably.
Why should I believe this time is different? Is this going to be a repeat of the 2008 oil shock?
That is the ultimate question. And it's totally understandable why people are having flashbacks. But based on the recent analysis, we need to draw a very sharp distinction between the fundamental mechanics of 2008 and today.
Okay, break that down for me.
The 2008 crisis was what economists call a structural crisis.
Meaning the structure of the whole global economy was just out of balance.
Precisely. Back in 2008, we had a massive permanent surge in new demand coming online from rapidly industrializing countries, specifically China and India.
Right.
Hundreds of millions of people were joining the middle class, buying cars, building infrastructure, and consuming vastly more energy.
And the supply couldn't keep up.
Exactly. At the exact same time, global oil producers simply did not have the spare capacity to pump more oil out of the ground to meet that surging demand.
So if we go back to our everyday analogies, the world's gas station was genuinely running dry, and the line of cars waiting to fill up was getting permanently longer every single day.
That is the perfect way to look at it. It was a genuine scarcity of the physical product.
But today is different.
Fundamentally different. What we are experiencing right now is a geopolitical and logistical shock. The oil itself exists in abundance. The global supply capacity is actually quite robust.
So in today's scenario, the world's gas station is totally full of gas.
Hmm.
The underground tanks are completely topped off, but the delivery truck bringing the gas to our local station is stuck in a massive, highly dangerous traffic jam on the interstate.
Exactly right. And it's vital that we view this situation objectively based on the data. The military conflict involving Iran has created severe physical hazards in critical maritime choke points.
Right. And to be clear for everyone listening, this isn't about taking a political side on the conflict itself.
Not at all.
It is simply acknowledging the physical, geographic reality of global shipping routes based on the research.
Right. The Strait of Hormuz is one of the most important energy choke points on the planet. When it becomes a high-risk area, commercial ships are forced to reroute.
Which means massive detours around the entire continent of Africa.
Exactly. Trips take weeks longer, fuel costs for the ships go up, and insurance companies charge a fortune to cover the vessels. But the physical commodity, the oil itself, is not disappearing from the planet like we feared it was in 2008.
Okay, the distinction between a structural shortage and a logistical traffic jam makes sense.
Good.
But here's where we need to look at the darker side of the data. Everything we've discussed so far sounds cautiously optimistic.
True.
The White House is calm, the futures market thinks the panic is temporary, and we aren't structurally running out of oil. But looking at the market analysis from March 7th onwards, things are getting much, much more complicated.
They really are.
This temporary traffic jam is starting to look a lot more threatening.
It is. And the data reflects a growing anxiety. We are seeing a significant escalation on the ground, which translates directly to the markets.
How bad is the escalation?
Well, according to the recent reports, this conflict has already caused the biggest disruption to global energy markets in decades.
Decades, wow.
Yeah. It's no longer just a minor detour that will clear up in a weekend. And the rhetoric from major global energy players is reflecting that new severity.
Do we have an example of that?
Yes. The Qatar energy minister recently issued a stark, very public warning. He stated that if Gulf producers are physically blocked from exporting their energy due to the conflict spreading, we could see oil hit $150 a barrel.
$150 a barrel. That is a number that would send shockwaves through the entire system.
Absolutely.
And we don't even have to wait for 150 to see the damage because we are already seeing this hit the American wallet right now. It's not some abstract future threat.
No, it's very real today.
According to the data, U.S. retail gas prices jumped over 10% in just one single week.
Tip.
We just hit a national average of $3.32 per gallon. That is the highest it has been since September of 2024.
And remember, 332 is just the national average.
Yeah.
In many parts of the country, especially on the coasts, it's significantly higher.
Right.
Now, there is a common defense mechanism here. People often point out that the United States is in a uniquely strong position globally.
Because we produce so much of our own energy.
Exactly. The U.S. is a net energy exporter, which does provide a massive buffer. Because we produce more crude oil and natural gas than we consume, we are absolutely protected to a much greater degree than regions like Europe or Asia.
Because they are fundamentally reliant on imported energy just to keep the lights on.
Exactly.
But even with that domestic production shield, everyday Americans are definitely not immune to this, right? I mean, I hear we are an exporter, and I think, great, let Europe worry about it.
A lot of people think that.
Are you telling me that's a false sense of security?
It is a false sense of security. Because energy markets are globally connected. A barrel of oil is priced on a global market. If the global supply tightens, the price of American oil goes up too.
Ah, I see.
Furthermore, and this is the really critical point that gets overlooked, it's not just about the unleaded gasoline you put in your family sedan. It's about diesel.
The fuel for the 18-wheelers.
Exactly. Diesel is the blood in the veins of the modern economy. It powers the freight trains, the cargo ships, the farming equipment that harvests our food, and the massive trucking fleets.
It moves everything.
Right. When diesel spikes, the logistics cost of moving absolutely every single product you buy spikes along with it.
So the cost of trucking groceries from a farm in California to a supermarket in Ohio goes up.
Yes, the cost of your Amazon deliveries goes up. This threatens to reignite inflation across the entire board, bleeding into food, clothing, and consumer goods, just when the Federal Reserve thought they had inflation under control.
And the broader financial markets are absolutely starting to feel that heat. It's moving beyond just the commodities desks.
Very much so.
Based on the analysis, we're seeing the US dollar strengthening, which sounds good, but actually makes our exports more expensive and hurts multinational corporate profits. We're
Exactly.
seeing bonds weakening, and the broader stock market is really feeling the pressure. What started strictly as a political and military issue halfway across the world is rapidly bleeding into a massive macroeconomic headache for the average American trying to balance their budget.
Which brings us to the most critical analytical point of this deep dive. This raises a massive question. Is the market's initial assumption simply wrong?
You mean the assumption that this is just a quick traffic jam?
Right. The initial pricing, that backwardation, the concert tonight panic we talked about, assumed a quick, clean resolution. But as the days tick by and the disruption drags on, that underlying premise is being severely tested. A temporary shock is only temporary if it actually ends.
Right. If you're stuck in traffic for 20 minutes, you're annoyed. If you're stuck in traffic for 3 days without moving, you have a crisis. So let's pivot to the actionable side of this. For the everyday American listening to this deep dive, who manages their own retirement account or just wants to be prepared, how should they navigate this?
What?
Based on all the research data, what are the key indicators we need to be watching?
The first and most critical insight is what we can call watch the gap.
Watch the gap.
For the average listener watching the evening news, the instinct is to just look at the daily headline price of oil scrolling on the ticker. Oh, oil is at $90 today.
Right, the big flashy number.
But that daily headline number doesn't tell you the whole story. You need to watch that term structure we discussed earlier.
You mean the gap between the tonight concert ticket and the ticket 6 months from now, that $10 premium?
Exactly. Right now, there is a $10 gap because the market thinks the future will be calm. But if you start to see the 6-month futures price shooting up to match today's immediate price, that is the ultimate alarm bell.
Why? What does it mean mechanically if that gap closes?
If the 6-month price rises to meet the current inflated price, it means the massive collective intelligence of the global financial market has officially abandoned the temporary traffic jam theory.
Oh, wow.
It means the smartest money in the world is bracing for a long-term structural crisis. They no longer believe the logistics will be resolved in a few months. That is the definitive signal that inflation is going to be sticky, interest rates might have to stay higher for longer, and the economic pain will be prolonged.
Okay, so watch the 6-month futures price to see if the market gives up hope. What's the second insight from the data?
The second insight is understanding how to position around the U.S. shield. We mentioned earlier that the U.S. is a net energy exporter.
Right.
In a global energy crisis, while we still feel the pain at the pump, this fundamentally changes the math for American investors compared to the rest of the world.
How?
Because of this structural economic advantage, the U.S. dollar and broad American market indexes, like the S&P 500, possess a resilience that others don't. They're likely to hold up much better than European stock markets or emerging market economies, which could be facing severe recessions if energy costs remain high.
So panic selling your diversified American index funds at the first sign of geopolitical trouble might not be the right move.
Usually not.
Because the U.S. actually has a built-in macroeconomic shock absorber that other countries simply do not have.
Precisely. In times of global stress, if capital gets scared globally, it historically flies to the safest, most robust asset. Traditionally, that is the U.S. dollar and U.S. equities, which further strengthens our market position relative to the rest of the world.
That makes a lot of sense.
However, there is a mathematical limit to that shield, which brings us to the third and perhaps most crucial insight from the analysis, the corporate breaking point.
And this is where the macroeconomic theory meets the reality for the companies we invest in, work for, and buy from every day.
Right. According to the research data, there's a fascinating breakdown from a chief investment officer outlining this exact breaking point. The consensus among market analysts is that corporate earnings across the broader economy can generally survive and absorb the higher supply chain costs if oil stays under $120 a barrel.
Break that math down for me. Why is 120 the magic number? Why can a company survive oil at 105 but completely collapse if it hits 121?
It comes down to the limits of consumer price elasticity and margin compression.
Okay, simple terms.
If oil is at $100, transportation costs go up. A company can pass some of those costs onto the consumer by raising prices slightly. They take a small hit to their profit margins, but they keep functioning. The consumer grumbles, but still buys the product.
Right, business as usual, just a bit more expensive.
Exactly. But at $120 a barrel, that dynamic shatters.
Because the consumer simply taps out.
Exactly.
Yeah.
Industries that rely heavily on fuel airlines, global transport, chemical manufacturing, and companies making everyday consumer goods have to raise their prices so high just to cover the fuel costs that demand destruction kicks in.
The breaking point.
Right. You raise the price of a family plane ticket by $30, people still fly. You raise it by $200, families cancel their vacations. At $120 a barrel, revenue drops while operating costs are peaking. Their profit margins absolutely get crushed. At that point, the U.S. shield won't be enough to protect the broader stock market from an earnings recession.
Wow. So to summarize where we stand right now, the White House is projecting a very deliberate outward calm.
Yes.
They are essentially saying, if it goes up, it goes up, prioritizing the geopolitical mission over gas prices. But that public calm relies heavily on the financial market's internal belief that this is a short-term logistics nightmare, a massive traffic jam, not a permanent drought of resources like we feared in 2008. And the market's backwardation, that $10 premium for immediate delivery, proves that Wall Street currently agrees with the White House's optimistic timeline.
For now, yes. The data supports that alignment.
Right, for now. But with the national retail gas average already sitting at $3.32 a gallon, diesel prices threatening to reignite inflation, and the geopolitical disruption dragging on with no immediate end in sight, that premise is being severely tested every single day.
It really is.
The longer the delivery truck is stuck in traffic, the harder it is to call the delay temporary.
And that leads to a really profound structural question that I think everyone listening should mull over today.
Let's hear it.
We rely so heavily on the financial market's ability to efficiently price in short-term disruptions. We trust the futures market to tell us the truth about tomorrow. But if a temporary traffic jam in the Strait of Hormuz lasts just a few weeks too long, at what point does a temporary logistical headache permanently rewire the mechanics of global trade?
That is a staggering thought.
It really is. If global shipping companies decide the Middle East is simply too risky on a permanent basis, if massive supply chains have to be completely redrawn around the Horn of Africa, the baseline costs of absolutely everything we consume will fundamentally change.
The whole system would have to adapt.
Right. Are highly optimized just-in-time global supply chains simply too fragile for modern geopolitics? That is the real long-term issue simmering beneath the daily headline price of oil.
What a phenomenal reality check to end on. It really makes you look at that $3.32 sign at your local gas station in a completely different light.
It's definitely more than just a number.
It's not just a number on a pump. It's a real-time pulse check on global stability and the fragility of our supply chains. We will keep tracking this data closely as it develops, specifically keeping an eye on that 6-month futures gap and whether we approach that $120 corporate breaking point. Don't forget to subscribe and hit that like button.